Hello students, these are the slides of chapter number 17, projecting cash flows and earnings from Fundamentals of Investment by Jordan, and this is the 8th edition. In this chapter, the author talked about an imaginary company and try to forecast its income statement and balance sheet statement for the future using the data from the statement from the previous year. So in short, he is trying to generate the Forma income statement and the balance sheet for the company. So the name of this company is the Borg Corporation, and the author has given the balance sheet and income statement from the year 2535 and 2536. Very funny years, but it's just the imaginary company from the for the few for the two imaginary years they have given. So I would advise you that while going through these this video and these slides, keep your calculator with you, and it would be better if you can take the printout of the balance sheet and the income statement of the previous year of this company. If you have the printer, or try to take a screenshot so that you can go back to the numbers very frequently when when I'm doing the calculation over here, so you can go and check the number from the balance sheet of this company from the previous year. So here's the balance sheet of the Borg Corporation. We can see that we have current assets, cash, account receivable, prepaid expenses, material and supplies, and inventory. So the total of the current asset is this. Likewise, we have fixed assets, and once we add all the assets, we will have the total assets in the year 2536 as 88,000. Then on the current liabilities side, we have the short-term debt, we have the accounts payables 5,000, long-term debt. In short, if we add all the liabilities and the equity we have paid in capital and retained earning, and we will end up having the total of liability and equity as 88,000, which is what we are expecting from a balance sheet, because the accounting the identity equation is total assets is equal to the total liabilities plus the total equities, right? And it's also mentioned that the price of the stock at the end of the year 2536 is $40, and the outstanding shares are 2,000. Now, this statement can be condensed as this. So if you go back to the main statement, you can see that you have a cash of 2,000, and then you have operating assets, which is 6,200, 1,500, 1,300, and 9,000. If we add from 6,200 to 9,000, you will end up getting the operating assets. The sum of the fixed asset is actually already given separately, which is 60,000, but then you have goodwill and other asset. We can add them together, it becomes 8,000. So you have all this over here in the condensed version of the balance sheet. We also have the condensed liability and equity side of the balance sheet. The good thing about doing this or generating this condensed version is this, that you have less items to see and figure it out that what is the major category where you have most of the assets, or say the liabilities. For example, we can see that most of the assets are composed of fixed asset, and then we can also see that the major thing we have is the long-term debt, which is 30,000. We also have a 40,000 of shareholder equity. The segregation is 10,000 in, I think, retained earning, and the 10,000 in the paid in capital, and 30,000 in the retained earning. So this is the condensed version. When we move to the income statement, we know in order to arrive to the income statement's last item, which is mostly the net income, we start from the revenues, we subtract all the expenses, and we'll come to the net income. And from the net income, either we can pay the dividends, and whatever is left over, it is the retained earning, which can be plowed back into the company for the purpose of for the growth of the company. So the dividends are paid to the equity holder, and the rest retained earning will increase the book value of the shareholders. So for the 2536 year, this is the income statement of this imaginary company, which is Borg Corporation, and its net sales is given like 110,000. Then you have cost of goods sold 89,000. Once you subtract the cost of goods sold from the net sales, you arrive at the gross profit, from which you need to subtract the depreciation and operating expenses. You arrive at the operating income, and then you have the interest expense, which you have to pay on the liabilities. So it was given that the company has taken 10,000 more loan in under the head of the long-term liabilities. So it's a long-term liabilities. Might be they have issued the bond, but they have taken 10,000 in the year 2535, but right at the end on the 31st December. So for most of the year, they have only 20,000 uh, under the head of the long-term liabilities. And on that 20,000, they were paying the 8% interest. And on 10,000 short-term liability, they were paying 4% the interest. So 4% of 10,000 is 400, and 8% of the 20,000 for because they are paying 8% on 20,000, which is the long-term liabilities. Then it is 1,600. So 1,600 plus 400, 2,000 they are paying under the head of interest expense. Once we subtract the interest expense from operating income, we'll arrive at pre-tax income, from which the 40% is the tax rate. If you calculate the 40% of the 6,000, and in fact I'm doing the calculation along with me, you will get 2,400, which is the income tax. And then you subtract this income tax from the pre-tax income, and this will give you the net income. From the net income, 30% is the payout ratio. So 1,080 is paid as a dividend, and the 70% of the net income is the retained earning, which will be kept as the retained earning, and it will increase the book value of the company. Now, if you see that the main thing is this, that net income does not necessarily reflect the cash flow. We have to do some adjustment to arrive at the cash flow statement. So the net income has few items like depreciation, which are non-cash based expense. It does not decrease the cash of the company. It decreases the taxable income, which is good, because now the company has to pay less taxes because the company is subtracting the depreciation, which is a non-cash cash based expense, from the revenues, and it will decrease the taxable income, and company has to pay then less taxes. But it has not decreased the cash, so the cash and net income can be different. So in order to generate the cash flow statement, we will see that we have to do some adjustment with the depreciations. So cash flows In the cash flow statement, the cash is categorized under three main categories: operating cash flows, investment cash flows, and financing cash flows, right? So operating cash flows are the cash flows which are generated by the operations of the main business. So whatever the cash flow which is generated by the operations of the business. Then you have investment cash flows, which is basically reflected by that what investment, what major capital assets you have bought. So, for example, the company might have done some major transaction in terms of investment in the assembly plants. Might be they have started an assembly plant, something like this, or they have bought a major piece of land on which they have to erect that assembly plant. So all that are the investment cash flows, which include the purchases or sales of purchase of the fixed assets and investment. So normally those assets which can keep generating the 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 sales for the company for more than 1 year period of time, those will go under the investment cash flows. Likewise, if you sell some major, let's suppose it's a there is a company Toyota which has decided to sell its old plant. uh, the proceed which come out from that, from the sale of that plant, will be basically a source uh, of cash flow, and it will be categorized under the investment cash flows. Finally, we have a financing cash flows. If the company has generated the funds by selling any security, if it is an equity or the bond, it will come under the financing cash flow, and it's a source because the company has issued the security to generate the cash flows. And likewise, if they are buying back their security, so they are paying to the holder of the security their money back, this is actually the usage. It's a usage of the cash flow, so it will decrease the financing cash flow over there. So here we can see that in order to generate the cash flow statement for 2536 for Borg Corporation, from net income, which was 3,600 for this year, we added back the depreciation. We arrived at operating cash flow, and from this we can subtract the investment cash flow. So the reason for this 1,500 is this: that on 31st December 2536, they purchased some distribution facilities, and they are hoping that it will increase their sales for the next year, which is 2537. And while buying it, they have to buy it at 15,000. So that will be a usage of the cash flows under the head of investment cash flow. So this will decrease their cash flow. And then financing cash flow is 8,920. Actually, they they got they sold the bond at 5%, and the value, the collective value of that bond is 10,000. So they generated 10,000 under the head of long-term liabilities at the end of uh, 2536 year. And 1080 they paid because as a dividend. If you see on few previous slides that this 1080 is actually this one dividend. So they paid the dividend. This is the usage of the cash under the head of the financing cash flows, and 10,000 is the source of the cash. So the net is 10,000 minus 1080. So that will generate the net source of the financing cash flows, which is 8,920. If you add 6,600 and from this you subtract um, uh, 15,000 and add 8,920, the net increase of the cash is 520. So this increase will be reflected in the balance sheet of the company. So if you see that, go back to a few previous slides or within this video, you'll find that the cash flow for the year 2535 will be uh, 1,480, and the cash flow for the year 2536 year is 2,000. So the difference is this 520, this one, which you can see in the last line, which is net cash increase. Now we have few ratios, important ratios, and we can use the information from the company's annual statements to generate these ratios. So gross margin is the gross profit divided by the net sales. That if this is in terms of percentage, let's suppose if uh, uh, this is showing a 20%, it means that from every dollar the company is paying 80 cents in the form of cost of goods sold, and rest 20 cent is actually going towards the gross profit. And from this gross profit, you still have to subtract the operating expenses, you have to pay the interest, you have to pay the taxes from that 20 cents from each dollar which is generated by the company. And then you have the operating margin, which is the operating income. So this is before paying the taxes and the interest rate. What is the actual operating income? So means uh, subtracting the cost of goods sold and all the operating expenses. You might have paid the salary of the marketing department. You have also paid, you have subtracted the depreciation, advertisement cost, and once you are left with the final income from which you still have to pay interest expense and taxes, that is usually the operating income. And if this is say 7%, then it suggests that from each dollar uh, net sales, the company is saving 7 cents, or some company, after paying all these operating expenses and cost of goods sold, company has 7 cents left. And from that 7 cents, they still have to pay the interest and the taxes. The return on assets and return on equity, the return on asset is simply the net income, means we have paid everything, even the taxes, and once you divide that net income with the total asset, that will give you return on assets. Return on equity will give you that what the equity holder are getting in return, and which can be generated by net income divided by the stockholders equity. So this is the profitability ratio for the Borg Corporation for the year 2536. So the gross margin is gross profit divided by the net sales, which is 19.09%, because the company's gross profit is 21,000 for this year and the net sales was 110,000. The operating margin is 8,000 out of 110,000, means from each dollar sales, net sales, the company is saving 7.27 cents, and from this they still have to pay the taxes and the interest expense. And what is the interpretation of the gross margin? From each dollar they are saving 19.09 cents. So rest 79.93 cents has gone in the shape of cost of goods sold over here. right? So what is the return on assets? 3600 divided by 88,000, 4.09%, and return on equity is the, because the shareholder equity is 40,000, it's 9%. So if this is very important, if the company do not have debt at all, then return on assets and equity is the same, because they do not have debt in their capital structure. But if the company has debt, and the interest on that debt is less than the return on assets, return on equity is always higher than the overall return on assets. So imparting more debt into a company means that the equity holders are effectively using the debt holders funding to generate the return from them. That's why the equity holders are getting much more. Even the return on assets is just 4%, 4.09%, but the equity holders are getting 9%. The reason is this, that again, from this return which they are getting on the asset, they have to pay relatively less interest to the debt holders, and the rest is basically contributing towards their return, which is increasing their return over here, 9%. So if both there is zero debt, then they both will be same. But in this situation, because they have a debt, the short-term liabilities and the long-term liabilities, the return on equity is different than the return on assets. The book value per share for this company we can easily calculate. On one of the slides, it is clearly mentioned, in fact, where the balance sheet is given, that the company's shareholder, the outstanding shares are 2,000. So if the outstanding shares are 2,000, then the book value per share is 40,000 divided by 2,000. The earnings per share is your net income divided by shares outstanding. So the outstanding shares are 2,000, so 3,600 divided by 2,000. So the earnings per share is $1.80. The cash flows per share, whenever we are talking about cash flows, we are talking about operating cash flows only over here. So the operating cash flows, remember, from the net income we added depreciation, so we arrived at 6,600 divided by 2,000, which is the shares outstanding. We have the cash flows per share, which is $3.3. Now we can easily calculate the price to book value ratio, because we can divide the stock price. The stock price was also given on the slide where the balance sheet was given for the year 2535 and 2536 for this company, right in the bottom if you go. And this stock price was $40. So 40 divided by 20, which was the book value per share. Remember, both numerator and denominators are in terms of per share. So 40 divided by 20. So book price to book value ratio is 2. Then you have price to earning ratio, which is 40 divided by earnings per share 1.8 is 22.22. And the price to cash flow is 40 divided by 3.3, which is 12.12. And if you recall, in one of my video, I told that what is the interpretation of P ratio, that for each dollar generated by the company's share, the investors are willing to pay $22.22 for this stock. So this is the interpretation of P ratio. And the main purpose over here, and if you see even the name of this chapter, is about forecasting, that we want to forecast that, okay, if this is the situation, what will happen into the future. With the future, when you move ahead, there are a lot of assumptions to make, and sometimes this was the difference between a good analyst and an average analyst, that how this analyst will be able to justify those assumptions. What are the basis for those assumptions? If like the good analyst will have answers or the logical reasoning that why he's making these assumptions. So the assumptions are very important. But over here, uh, most of the data regarding the assumptions are given in this chapter. But in real world, it's only comes with this skill about making the assumption and trying to generate. Obviously, this is about future. You cannot exactly come up with the numbers of these financial statements about future, because there is a lot of uncertainty regarding the future. But a good analyst will be able to generate those numbers which will be relatively very close to the actual numbers when the actual statement will be generated. So the main thing is this, that making a logical assumptions in order to generate the future forecast is the key, and that usually come with the experience. The good thing about this chapter is that most of the assumptions are given, and using that we can see that how we can proceed forward to find the pro forma income statement and balance sheet for this company. So let's suppose if there is an analyst, let's suppose you are the analyst and analyzing this corporation, and in December 2536, this company has shown that they have acquired a distribution outlets from Klingon Enterprises, and the reason was this: they wanted to increase their sales. So the company's marketing campaign and their goal is to increase the sales to 137,500. So remember, what was the sale in the year 2536? It was 110,000. But for the following year, which is 2537, they wanted to increase the sales to 137,500. So pause over here and see that how much percentage increase they want. So yes, you're right. They wanted to increase the sales by 25%. So now the main job over here is to examine the potential financial impact from these announcements on the Borg Corporation. This is, as an analyst, this is your job, and you want to see that how uh, how much funds are needed to support this level of sales. Does the company already have enough financing? Usually when the sales increase, company need some extra finance, and we need to see that how much external financing is needed, EFN is needed, to support this level of sales. So let's see how we'll proceed forward. So we have to make a lot of assumption. We will start with the percentage of sales approach. So in percentage of sales approach, we try to use this to build the pro forma financial statement about the future, and the pro forma financial statement is basically a forecasted statement for the statements means income statement and balance sheet. From the given data, from the previous data, we are trying to forecast into the future. So these are pro forma financial statements. And percentage sales approach means that most of the items will be will remain at the same percentage level of the total sales of the company. For example, if the inventory in the previous year, in the last year, is say 10% of the total sales, so in the next year it will also remain as 10% of the total sales. So we will attach it with the sales, and when the sale is increasing by 25%, then many items will also increase by the same 25%. But this is a very big assumption. Making this assumption for few items is very reasonable. For example, account receivables, but not for all the items, like long-term debt. Long-term debt is totally at the discretion of the management. If the management wants to raise the debt, then it's fine. But might be they will not increase in by the same ratio. If the sales are increasing by 25%, not necessarily they will increase the long-term debt by 25%. They might say that, okay, we are increasing it by just by 10%, and the rest, the equity holder will chip in. Though we know that equity is a costly way of financing, but it depends what sort of the the capital structure policy the management is pursuing. So for few items, this is a reasonable assumption that they will remain at the same level of percentage of the sales. So the ratio will remain the same for few items as a percentage of sales, but for other item it might change. And this thing will be clear once will see on the Excel sheet. I will show within few minutes that how we can proceed forward with the with this process regarding the Borg Corporation on the Excel sheet. So there are few assumptions they are making. For example, the ratio of the total cost to net sales is about 94.55% in year 2536, and we are assuming that this ratio will remain the same in year 2537. Means that the margin net margin will remain the same for the next year as well. So depreciation uh, 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 is actually a very complex topic, and accountants handle the depreciation in a many ways. They generate different depreciation schedule. It's not an easy way, but over here, in order to keep the thing simple, we are assuming that the depreciation will also remain the same as a percentage of sales. So for the previous year, which was 2536, depreciation was 3000, and 3000 divided by 110,000, which was the sales, it is actually almost 2.73%. So this 2.73%, if you simply divide it, so this percentage will remain the same for depreciation for 2537 year. That means next year. Again, it's a very simple assumption, but at this time we are going with this simple assumption because uh, there are many ways the accountants handle the depreciation, and it's complex ways, but for the purpose of this chapter we are keeping it very simple. So if we have 2.7%, then if we multiply this 2.73% with the forecasted uh, sales level, which is 137,500, we will get 3,750, and that will be our depreciation for the next year, which is 2,537 year. There are again further assumptions. The interest expense is 4% interest on the short-term debt, 8% interest on the long-term debt, which the company has already acquired, and it was also shown in the year 2535 financial in fact balance sheet. If you go on the, I think, very first or second slide, you have two balance sheets, so you can see that there is 20,000 written in the long-term debt. Then in the year 24, right at the end, I think, or 2536 year, they also acquired 10,000 long-term debt. That increased their total debt to 30,000. So the additional 10,000 they are acquiring at 5%. interest. And the tax rate is 40%, and dividend are constant percentage of the net income. And this is based on this thing. This is uh, uh, the Performa income statement generated for year 2537. Now let's see how this number is generated in detail based on these assumptions. So I have an Excel sheet over here. And you can see over here that the cost of goods sold is 80.91% of the net sales for the year 2536. So if you see this calculation over here, 89,000 divided by this is the same 0.809091, which is 80.91%. And if we multiply, if for this is actually the future year, this is the pro forma statement. This year has not yet happened, year 2537. So if we simply multiply this, if we want to maintain this 80.91 for the next year, which is 2537, you multiply this with the sales level of the future year, and we'll come to the cost of goods sold, which is 111,250. Actually it is 111,251, but because this is estimations anyways, I'm in fact not I'm even in the book they are rounding that off nearest to the tens. So this is rather 251, they are writing it as 250. Once we subtract this, we'll come to the gross profit. So this is our gross profit. Depreciation, we have already calculated. If you divide 3000, this one with 110 over here, this one with this one with this, you will find it's 2.73%. And this is a very simple assumption. We are maintaining that for the future, the depreciation will remain at the same level. So the 2.73% of the sales level of 137,500 will actually generate this much depreciation. Now, this other operating expense is a plug variable. And the plug variable means that we can adjust this number manually. We are not tying this operating expense as a percentage of the total sales. So this variable can change, and we can change in such a way that our overall total cost to net sales must remain at 94.55%. Why 94.55%? Because the total cost, which was for the previous year, based on which we are generating the future income statement, is have cost. When we added up that cost and divided it with the sales level of 110,000, we have a total cost of 94.55%. So what are those costs? Let's see first. So this is actually your cost of goods sold, D4 over here, right? Then you have depreciation, 3,000. You have other operating expense, which is 10,000. And then you have interest expense, which is 2,000. If you add this, and this, and divide it with 110,000, so all these numbers, expenses, so with the 110,000, your total cost to net sales ratio will remain 94.55. We want to maintain that. So this number is a percentage of the total sales, which is 80.91. This is also a percentage, right? This is also a percentage. This is not a percentage, so this is a plug variable. We'll change that. But in order to do this, first you need to plug this number, interest expense. So how do how can you calculate the interest expense? Remember I told you that this is the schedule over here. You can see in the comments, 4% is on their short-term debt, which was 10,000. So 4% of 10,000 was 400. 8% of 20,000 is 1,600. So this was the debt which they already had. And right in the end, like in the uh, at the end of year uh, 20, or you can say at the start of 2536, they have acquired further 10,000 debt at 5%. So the interest related to that will be 5% for the following year. So so that 5% is 500, and you add all this interest, it will generate 2,500. So you can see that it is all, like, it is not exactly the following the percentage sales approach as approach as well. So now if you have this 2,500 as an expense, 2,500 as an expense plus the cost of goods sold, which we for the 2,537, which we have calculated based on the percentage sales of approach, 111,250, plus the depreciation, which is 3,750, and divide it by the net sales. It will generate a total cost to net sales ratio of this. But remember, this is it has one element missing. Can you pause and see what is that element? Yes, you're right. That element is the other operating expense, and this is the plug variable. We want this ratio to remain as 94.55%, but we have 85.45%. So we need to plug in such a number for the other operating expense that once we plug that number, this number becomes 0.9454. In other words, 94.55%. So that number needs to be 12,500. So this is not as a, it won't change as a percentage of sales. It is a plug. That's why I have written plug over here, plug variable, right? So you can also see that once we plug this number, 12,500, our ratio of total cost to net sales is the same, 94.55%. So once we plug this number, then what will happen? That both of these, depreciation and other expenses, will add up and needs to be subtracted from the gross profit. We will arrive at the operating income, which is 10,000. The interest expense we have also calculated based on our this 2,500 is simply the weighted cost of debt, right? Because there are different debts present in the debt. So our debt structure is based on the debt reflecting interest. Different interest rate needs to be paid on different portion of debt, and this is 2,500. Once we subtract this from 10,000, we'll arrive at pre-tax income of 7,500. From here, if we subtract, we will pay 40% income tax, which is 33,000. We'll arrive at the net income, which is 4,500. And one of the assumption is this, that 30% dividend payout ratio will remain the same. So 30% of 4,500 is 1,350. We'll arrive at the retained earning, which is 3,150, right? So the profit margin will remain the same, because we have, if you are saying that my total cost to net sales ratio will remain the same, it essentially means that your profit margin will also remain the same. So this is how the pro forma income statement of the company is generated.